Good evening, everyone. We're going to be talking this evening about candlestick formations and basically price action um, patterns, right? Price action patterns, right? And when we talk about price action, most of the time we are referring to candlestick formations. How does a candlestick form? Right? Now, when you understand how the the um, the science behind the candlestick itself, you understand that the candlestick is always telling us something about what has happened in the market already. Candlestick is always telling us what has happened in the market already. So we are reading candlesticks to determine what the market has already done and consequently what the market will do next, right? So everything, every data within an hour, for example, if you're on a chart and you have a 1 hour candlestick, what that 1 hour candlestick is telling you is everything that happened within the space of 1 hour is what is captured within that candlestick. Everything that happened in the market with respect to that instrument within the space of 1 hour is what is captured inside that candlestick. So it's showing us historical data. It's showing us historical data. That's what it's showing. Everything that happened within the past 1 hour is captured in that candlestick, right? So what we're going to be talking about here is understanding the fact that when we talk about price action, we are referring to candlestick formations. And these candlestick formations are so key in the market because the way a candlestick forms tells us what's going to happen next, what's likely to happen next. The way a candlestick forms tells us what's likely to happen next with that candlestick or in the market, right? So, and we know that when you're in the market, most of the time you're looking to either be buying or selling. You're looking to buy or sell. So if you're looking to buy or sell, what are those signs in the market that are telling you that your potential buy trade has a high possibility? What are those signs in the market that are telling you that your potential buy trade has a high possibility? And what is it that's telling you in the market that your potential sell trade has high possibility? Right? So that is what this is about. That's what candlestick formation is about. Because if you understand candlesticks, then of course you can do a whole lot. And there are strategies that are built around just candlestick formations. How a candlestick forms tells you a whole lot. By the time you look at 1, 2, 3 candlesticks, sometimes it's just one, sometimes it's two, sometimes it's three. You put together that candlestick formation, you'll be able to see a whole lot that's happening in the market. What kind of wick did the candlestick close with? What kind of shadow did the candlestick close with? How did it, in relation to the previous candlestick, how did it close? All those things are so key when trying to determine what's likely to come next. And what is likely to come next is always our focus in the market. It's always our focus. So if I'm going to buy, now I have to have a clear picture of what the previous candlesticks are telling me about what's going to happen next, what's likely to happen next. Okay. If I want to sell, I have to look at what the last few candlesticks, of course, in conjunction with a couple of other things in market, but at least the last two candlesticks, what are they telling me about the possibilities of what's likely to come next? That's what this is all about, right? So there are many times you may have understood the concept of demand and supply in the market. And then when price hits a demand zone, you think, oh, I should be buying. Or when price hits a supply zone, you think, oh, I should be selling. And by demand zone, I mean demand zone is majorly what we call support levels. And then supply zone is also majorly what we call resistance levels, right? Now, if price hits a support level, a support zone, if price hits a support zone and you're looking to buy, what confirmations are you going to get? We call it confirmations because you need like 2 or 3 strike points. You need to be able to look at 1, 2, 3 things telling you the same thing that you're already expecting. If you're expecting to buy already, you're expected to enter a buy trade already, what 1, 2, or 3 things are telling you, or 3 signs, what 1, 2, or 3 signs are telling you, are confirming what you already expect to happen? What 1, 2, or 3 signs are confirming what you already expect to happen? We call it confirmations because when you come to any level in the market, any area in the market, there are so many millions of traders around the world watching the same candlesticks. Some of them are retail traders, some of them are institutional traders with lots and lots of monies to trade. And these guys can move the market. And so those confirmations give you, especially as a retail trader, the confidence that the market is likely to go in the direction you expect. And you are not always remember that you are not the only one watching the market at every given time. There are millions of traders watching. So, and they are likely to do the same thing that you are likely to do. That's why the market tends to be like a self-fulfilling prophecy sometimes, because you are expecting the market to buy and it starts buying. Why? Because when you expect something to happen, you likely take steps to make it happen. And as you do that, and in this case in the market, millions of other traders across the world moving monies in that direction, the market tends to respect it, right? It's like everybody's trying to buy something, whatever it is. If everybody's trying to buy something, the price is going to start skyrocketing. If everybody is trying to sell something, it means that something is wrong. The price is going to start dropping. That's the work. That's demand and supply in our regular world. But that's also the reason why prices buy or sell in the market. That's also one reason why prices buy or sell in the market. Currently, if you look at an instrument like gold, you see that gold has a very strong buy momentum. No matter how people are expecting, some people are expecting it to sell, it will not sell. It sells a little bit, makes a little pullback. Before you know what's going on, it has picked up again. Why? Because the momentum is very strong towards the buy side, and there are signs that are telling you to buy even more. So with those signs telling you to buy, then you are watching those, institutional guys are watching those, the market is going to be behaving in that way, right? So that's what we're trying to do here. So these are 5 powerful candlestick reversal patterns. Reversal patterns we talk about reversal patterns more because it is in areas of reversals. It is at areas of reversals in the market that there's opportunity for you to make a move. All right. Now, if price is buying, and if price is buying from level A, level B, when price is at level A, if you're expecting price to buy from level A to level B and then change direction at level B, it means that there's an opportunity at A for you to enter the trade. There's also another opportunity for you to enter at point B. Why? But in between point A and point B, once price starts moving from A to B, let's say in the middle between A and B, the opportunities there are what you call high risk, low reward. High risk, low reward. So the best opportunities for you to enter the market happen around areas of market reversals. That's why we focus more on reversal candlesticks. At point A, there's opportunity. At point B, when it is changing direction, that is where the next opportunity is. Usually at areas of reversals, that's where you have trades with high probability, and then you also have trades with high reward, low risk. High reward, low risk. Usually at areas of market reversal. So most of the time, that's why you see a lot of strategies are built around market reversing or market pulling back and reversing. It's always about reversing. Why is it about reversing? Even when it has to do with breakout of a level. If price breaks out of a level, it still needs to reverse before it continues. So you discover that most thing in the market is always around reversal. And that's what I'm trying to tell you now. Why is that so? It could be bullish reversal, it could be bearish reversal, it doesn't matter. Those reversal levels are where you find the trades with the best probability, to turn out in profit. And then those are where you find trades with good high reward, low risk. Trades with low reward, with low risk, high reward. That's when you find around areas of market reversal. So that's what we're seeing there, and that's the reason why we focus more on reversal patterns. So now here we're going to go to a few candlestick reversal patterns here. The first one is what we call the hammer candlestick. This hammer candlestick is, first of all, remember we're talking about bullish signs, bullish reversal patterns. Now, usually when you see this kind of candlestick, it's telling you that price is about to buy. Price is about to buy. This is, first of all, market has to be around areas of market reversal. And when we say areas of market reversal, we are talking about demand and supply zones like support levels, resistance levels, fair value gaps, those areas where you're already expecting market to change direction, to make moves. Those are areas of market reversals. Now, when you get to areas of market reversals, you shouldn't be buying if you are not in that area. You shouldn't be selling if you are not in an area of market reversal. So if you're in an area of market reversal, the next thing you want to do is a sign or a pattern that gives you confidence that the market is about to do what you expect, right? So these are some of them. These are patterns that give you a sign that market's about to buy. So one of them is a candle pattern called hammer. Now this candle pattern, see how it looks. It usually has either a tiny green or red body, a tiny green or red body, with a very long shadow below it, a very long candle shadow. Okay? A very long shadow or a long wick below it, and it has a small green or red body. That is what we call a hammer candle. Now, if the body is actually green rather than red, it's much better because that is more bullish than the red one. The red one is also good. If you have a candle pattern that is like this, and the real body is red, this is still good. It's still a valid hammer. Still a valid hammer, but in this case, it's still a valid hammer. But in that case, it is not as bullish as this. This one is more bullish than that one. The green one is more bullish than the red one. Right? So of course, if you see the red one, you might need to hold on a bit and wait for extra confirmation that you're sure that you're not getting into a trap in the market. Because the market has a tendency to trap people sometimes, right? Because there are lots of things that happen around these areas of market reversals. So many things. In previous class, we talked about liquidity grabs and all that. All of those things happen around market reversals. In the future class, we're going to talk about that more so that we understand what liquidity is all about, right? But so in those areas, there are times where the market tends to trap people. But when you have the best sign, best signals, then the market can basically you know the best patterns you should be seeing to make a decision on your trades, right? So the first one there is what we call a hammer candles. The next one is what we call an engulfing pattern. This is how an engulfing pattern looks. Okay, an engulfing pattern is, this is a bullish engulfing. For a bullish engulfing, you have a red candle followed by a huge green candle that tends to engulf previous red candlestick. And something else I should say here is it must be above support. This support here, when it says a support zone, above support zone, this is what I mean by areas of market reversal. So if you see a candlestick like this and it's in isolation anywhere on the chart, that is not a sign for you to buy or sell. A buy in this case. That's not a sign for you to buy in this case. It must be at a support zone and it must be above support. So if it's a support zone and you see this, then that is a good sign that market is about to do what you expect, which is buy. Okay. The engulfing pattern is the same thing. When you see a red candle followed by a huge green candlestick, and then it is a support zone, that is telling you to buy. It's a good signal for you to buy. In fact, when you are in a position where you can have multiples of these candle patterns, the better. There are some cases where you can have a bullish engulfing and a hammer together in the same spot. That's more like an extra confirmation to you, telling you that this is a good trade, a potentially good trade, right? I said potentially because it's not guaranteed still, right? It's not guaranteed still. And that's the reason why when you're trading, guys, it's advisable that you trade in such a way as to do proper risk management. Proper risk management. You're selecting your stop loss. You are picking the area where your stop loss should be. You pick it. You install your stop loss. You enter your trade. You use your proper lot size and so on and so forth, right? So when you've done that, you know that, okay, irrespective of what happens, this trade is not going to take all my money away. At least you know that, right? So make sure, guys, like I said, make sure your risk management is in place. When it comes to trading, I'll tell you this for free. Risk management is your number one winning advantage in the market. Risk management. No, all of these are what we call strategy. They are part of what we call strategy, right? But in the midst of all your beautiful strategies, if your risk management is not in place, it's just a matter of time before you start facing big challenges or making huge losses, you know? So very important. I just had to chip that in, to know. The third one is what we call piercing line. A piercing line is another type of candlestick pattern that is a bullish, that gives bullish signal, right? Now, how does he appear? You have a red candlestick. You have a red candlestick coming down, then followed by a green candlestick that tends to go beyond, that is coming up, but tends to go beyond 50% of the previous red candle. So it engulfs the previous red candle just beyond 50% of its length. So that's a way to know a piercing line. So you have a red candlestick followed by a green candlestick that goes beyond 50% of the length of the previous candlestick. So that is a piercing line. And it is a very good bullish signal. Very good bullish signal. And again, price has to be at reversal levels, which is at support levels. Okay? Support levels. Then the next one is what we call a dragonfly doji. Generally, a doji is a candlestick that opens and closes at the same spot. So if a candlestick opens, moves up and down, and then closes at exactly where it opened, that is what we call a doji candlestick. It's typically an indecision candlestick. We call it indecision. Indecision because you really don't know what to do with this kind of candlestick. When price opens and closes in the same spot, when price opens and closes at the same spot, what exactly are you going to, what decision would you make with that candlestick? You can't make any major decision with that candlestick because it's not clear where it's likely to go. It could go either way. So it's indecision more like, because the way a candlestick forms, like we said before, tells us what is likely to come next. If that is the case, if a candlestick opens and then closes at the same spot, then it's not very easy to tell where it's likely to go next. So in that case, you are still going to wait for it, watch until it moves into it forms another candlestick, and that candlestick now gives you a pattern that you can be confident about, right? So, but for this, we have what we call the dragonfly doji. The dragonfly doji is formed this way. Even though this candlestick is still like a doji, which means that it open and close at the same spot. That's why you see that this candlestick doesn't have a real body. It doesn't have a real body. It only has it has a tiny line here. That tiny line is telling you that it's open and close are the same. Now, when you look at this bottom here, you see this long wick. This long wick has the same or was formed from the same effect as this one, as a hammer. So that long wick tells you something. And that thing is telling you is that bias and bullishness is returning to the market. Bullishness is returning to the market. That's the reason why you're seeing this wick below. Buyers have pushed up, just like buyers pushed up here. Buyers are pushing up. That is the reason why this Doji candlestick has a long wick, a long shadow at the bottom. Typically, regular Doji candlesticks do not form like this. As much as they open and close at the same spot, they could open and close and form at the middle like this. So it will look like a crucifix. That is a regular Doji. But this one is not a regular Doji. You can see it's telling us something because of the long wick, the long shadow below it. That's what is telling us that bullishness is coming back into the market. And when you see that around support zone or market reversal zones, you should be looking to enter for a buy. It's giving you a very good sign to enter. And like I said before, the more the number of confirmations, the more the number of confirmations, the better. The more the number of confirmations, the better, right? Now, if you have this candlestick, Dragonfly Doji, and then you have another candlestick, let's say a bullish engulfing or something, or maybe you have a hammer or something, you have like 2 or 3, that is stronger confirmation. That's what you're looking for in the market. It's always recommended that you wait for confirmation. Most of the time, traders are too impatient. Most traders are too impatient, and then they end up losing the same trade they rushed into. So if you're rushing into a trade and then you still lose the trade, what's not the point? Why not be patient? And then you do it, you wait for you to see what the market is doing before you enter that trade. Okay. Then the next one is what we call a bull engulfing. Bull engulfing. Bull engulfing is another candle pattern. You notice that there's a bullish candle, green candlestick. Then it's followed by a green candlestick too. It's followed by a green candlestick too. And that green candlestick started out coming down, and then eventually bullishness returned to the market. And that bullishness that returned to the market shows in a long wick below the candlestick. That bullishness shows in a long wick below the candlestick, right? So that's the thing. Now, when you see that, you know that that is what we call a bull engulfing. And whenever that happens around the support zone, that is telling you that price is about to buy as well. Whenever you see that around the support zone, that's telling you that price is about to buy. Okay? So these are the 5 most popular bullish candlestick patterns. When you see these ones at areas of market reversal, especially at what we call support zone or demand support zone, support zones are also what we call demand zones. When you see these candle patterns at support or demand zones, then that is telling you to buy. If you see these candle patterns anywhere else on the chart, it doesn't count. If you don't see them at support zones, it will not work. It will not count. You have to see it at support zones. You have to see it at areas where market is already about to reverse. If you don't see it there, then it will not count. Okay? So that's why I said the opportunities lie around areas where the market is expected to reverse. All right. Okay, so these are just some signs here, some examples to show us. So I said before that there are 2 candlesticks. There's one green, there's one red. That are hammer candlesticks. Okay, they're hammer candlesticks. They are green, or they could have a green head or a red head. The one that has a green head is more bullish than the one with a red one. So if you see a red one like this, you might need extra confirmation to tell you what to do. You're expecting a buy. It's at a support zone. It's at a support zone. Excuse me. All right. So sorry about that, guys. Now these are the hammer candlesticks, right? Okay, so let's move on to the next. So this is how you find a hammer candlestick on the chart. Now remember, this area has to be a support area here. This area, it must be a support area. If this is not a support area, then this candlestick would not work. But as long as it's a support area, then this candlestick is seen as a bullish signal, a sign, and a sign that the market is about to buy. Okay. This is another hammer candlestick. This area here must be a support level, a demand zone. If it's a demand zone, then price is going to buy from here. If it's not a demand zone, then price is not about to buy from here. So if it's anywhere else on the chart, let's say you see it here, look at this now. Can you see this? This is almost like a hammer candlestick, almost like, it's not exactly like it, it's almost like a hammer candlestick. You see, but because it is sitting somewhere in a random location on the chart, it's not a signal that price is going to then start going up. No, it doesn't work that way. It only works around support levels, around support zones. Okay. So let's move on to the next. The next is what we call a bullish engulfing. This is the way it forms. Okay, I'll run through this very quickly. This is the way it forms. And when on your chart, you are looking for it, this is the way it appears, right? So this is it. You can see this now. Now, if you notice something, this candlestick looks very much like a hammer candlestick, and yet it is an engulfing candle. So when you see something like that, that is a very good sign that you are seeing something that will work out very well. Okay? So you are seeing a candlestick is a bullish engulfing, which means that it engulfed the previous candlestick. Then you are seeing a long wick as well. That's telling you that bullishness is returning to the market. The market is about to really take off and buy. That is a sign. The markets are about to really take off and buy, right? So this is the same thing here. So how do you trade this? You see a red candlestick followed by an engulfing candlestick, and then you enter on the next one and then you buy. You see? So patience is very important. I always tell people this. If a candlestick has not closed, don't jump into it. If this candlestick, if this is a 1 hour chart, and then you find this candlestick form like this, red, and then you see a candlestick, an engulfing candlestick forming until the time elapses, which is 1 hour, for this candlestick to fully form like this, do not take a decision on that trade yet. Do not say, oh, okay, this candlestick is about to form, yet there's still 10 minutes for it to, for the time to elapse. Let me jump in. I know it's going to close like this. You don't know it's going to close like this. You don't. This candlestick can surprise you in the last 1 minute. It will close down. It will come down like this and close red. Last 1 minute. It would have remained like this all 9 minutes. And then 1 minute later, it will just drop and close like this. It's very important to understand that candlesticks must close before you make a decision on them. If the candlestick has not closed, do not assume that it will close a certain way. It might disappoint you. That is what it means when you are trading what's in your mind rather than what you are trading, what the market is showing you. The market is showing you, trade what the market is showing you, not what's on your mind, right? So it's important that you trade what the market is showing you, not what is on your mind. Okay, what you are thinking should happen, what you are thinking is happening. Don't do that, right? Okay, all right. Um, so this is what we call a piercing line. What I said before, I said you can see this candlestick, you can see this candlestick, and then see a red candlestick followed by a bullish candlestick that crosses below that crosses above 50% of the previous line, 50% of the previous candlestick. That's what we call a piercing line, right? Once you see that, you know that this is a bullish signal. See here, bullish signal. So this thing, guys, what you need to do is you go to the chart, open your chart, and start looking for them. You open your chart, you start looking. You open your chart, you start looking. When you open your chart and look and look and look, you will find these things there. When you open your chart and look, you will find these things there, right? And then once you find it, you can then confidently start using them. Once you find them, you can confidently start using them. So these are what we call bearish reversal patterns here. Bearish candlestick patterns, just like we said before. The other ones are for bullish. They are bullish reversal patterns. These ones are bearish reversal patterns. The previous ones are bullish reversal patterns. These ones are bearish reversal patterns. Okay? So let's look at this now. You see that many of them, many times, is just the opposite of what we saw before. Many times it's just the opposite of what we saw before, because this is for bearish signals. So you have, first of all, we'll start with the inverted hammer. The inverted hammer is almost like a hammer, but in the opposite direction. It's like a hammer, but is in the opposite direction, right? So when you see that at a resistance zone, if you see that at a resistance zone, that is a sign that the market is about to do what you expect it to do, which is sell. The market is about to do what you expect it to do, which is sell. That's what you're looking for. Okay? Right? So, but make sure it's at a resistance zone. If it's not a resistance zone, there's a huge problem there. If it's not at a resistance zone, there's a big problem. You don't want to get into that. It has to be at a resistance zone. Okay? Then you have bearish engulfing. Bearish engulfing is just like the bullish engulfing, but this one is a bearish signal. Bearish signal. So you see that now. You see a green candlestick followed by a red candlestick, huge red candlestick, right? So when you see this sign, this tells you that bearish volume is entering the market. Bearish volume is entering the market. So if bearish volume is entering into the market, if bearish volume is entering into the market, what you should be doing is entering for a sell too. Because this is at a resistance zone. It has to be at a resistance zone. If it's not at a resistance zone, you'll have no business dealing in that trade. Has to be at a resistance zone. If it's at the resistance zone, then of course you get into that trade that you're saying, right? So it's very important the location of this signal when you see them. I'll say that again. It's very important that you note the location of these signals, the location of the signal. So if you take it at anywhere on the chart, you'll be doing the wrong thing. It's important you take it at the right location on the chart. Then the other one is what we call the dark cloud. The dark cloud is almost like opposite of what we call the piercing line. Piercing line is a bullish signal. The dark cloud is the bearish signal, right? So the dark cloud here, how does it appear? You see a bullish sign, a bullish candlestick, followed by a bearish candlestick that engulfs the previous candlestick more than 50% of the move, more than 50% of the length of the previous candlestick, right? It engulfs it more than 50% of the length of that candlestick. So that's what we call a dark cloud. And a dark cloud happening at a resistance level is a sell signal, a very strong sell signal. Very strong sell signal. Then you have a gravestone doji. right? Gravestone doji is the opposite of the other doji that we talked about before. Gravestone doji is the opposite of the kind of the one we talked about before, of the dragonfly doji. The dragonfly doji is the bullish one, while the gravestone doji is the bearish one. Bearish. So we have dragonfly doji bullish, gravestone doji bearish. Right? Now, when a bearish candlestick happens like this and you see it form like this at a resistance, that is a sign for a sell. That is a sign for a sell. It's telling you that buyers, sellers are stepping in huge volumes, and what you should be doing at that time is selling. What you should be doing is follow that suit. I always say something, guys. What we are always trying to determine in the market is, what we are always trying to determine and decide in the market is where the money is flowing towards. What direction is the money flowing in? What direction is the market, the money in the market flowing in? That's what you are looking for. Once you can decide the direction the money is flowing in the market, then you go in that direction. You are not the one moving the market. You and I cannot move the market. You don't have the finances to move the market. If you're trading certain currencies or certain commodities in the market, billions and hundreds of billions of dollars of volume is flowing through on a daily basis. Flowing through on a daily basis. How are you going to counter that move with your $1,000, your $5,000, or with your $20,000? You're not. So what you're looking for is trying to find the direction the market is going. Money is flowing in. If the money is flowing in the direction the market is going, right? So all of these signs are helping us to determine where the money is flowing towards. So when we see where the money is flowing towards, what we do then is we are able to get on those trades and trade. And the last one here is what we call the bear engulfing, just like we had a bull engulfing. The bull engulfing was a very strong bullish signal. The bear engulfing is the opposite of the bull engulfing, and then it gives us a very strong sell signal. Very strong sell signal. See a small candle, red candlestick, followed by a huge red candlestick that has a wick above it. That tells you price is going to sell. Price is selling. Price is selling. What you need to do then is get on that sell when it is happening around a resistance level. So the easiest way for you to do this, guys, is pick one or two or three instruments that you want to monitor. Identify these areas, these locations, these zones, these resistance zones, support zones, resistance zones. Identify them so that when price gets to that level, don't be trading 10 different instruments, 20 different instruments running around the market. No, that's not the way to do it. You pick one or two instruments, you focus on those, and then you go to different time frames. First of all, you start with a higher time frame, then you come to a lower time frame, and you come from a larger time frame to a lower time frame, then you are able to see what the market is doing. Okay? First of all, you're identifying the trend. The trend is what happens first. If you don't see the trend of the market, if you miss the trend of the market, you will be wrong. Right? So the first thing you want to do when you come into the market is, what is the trend? Where is the trend in this market? And that's what you are going to first of all obsess over. Find the trend, go to a higher time frame, come back, try to find the trend of the market. If you don't get the trend and you get on a trade that is wrong, just close. That's why you set your stop loss, close that trade and get out. Close that trade, get out. Once you close that trade, you get out, then you know, look, I got the direction wrong. Keep looking for the direction of the market. Once you get the trend of the market, then you confidently place your trade. You can confidently enter the market, place your trade, and expect that the trade will do exactly what you expect it to do, right? So all of these will just be confirming what you already expect to happen. If you're in an uptrend already and you're expecting market to buy, then you are looking for signs, bullish signs, because you already know the market is about to buy because you're already in an uptrend. If you're in a downtrend, that's when you start to use bearish signals. Market tends to go in the direction that is already going until that direction is changed. Okay, let's say that again. The market tends to go in the direction it is already continuing in the direction it's already going, except that direction is clearly changed. Some people sell when they see the market buying, hoping that the market will start to buy. It doesn't work that way. If you see the market selling, enter the market and sell or find opportunities to sell. Don't be the one to try to change the market. Don't be the one to try to change the market direction. No, you cannot change the market direction. You can only see, you can only observe that the market direction has changed, and then you follow in the direction that the market is currently going. Until you see that, you continue to follow what the market is telling you that it is doing. We understand that. So these signs here, these candle patterns here, are meant specifically for you to be used for you to be observed in the market. Observe them first. Observe them. Like I said, in order to not to be overwhelmed, pick only a small number of currencies. You should pick like one or two, and just essentially you can make money from any instrument in the market. Pick like one or two, stick with them. Then when you see a trade there, you confirm, you enter your trade. You make your profit, you're out of the market, right? You enter your market money, the market, you're out of the market. But you're trying to observe 10, 5 different instruments, and meanwhile you're still trying to understand how the market works. You find out that it becomes overwhelming and you start asking yourself, can I do this? Can I really make money doing this? But then the best traders are picking one instrument and sticking with it. They are trading $1 million. They're trading 100,000, 10,000, 20,000. And you that is trying to learn how to trade and you're still new to trading, you're trying to trade 10. How is that going to be? Right? So the first thing is pick one instrument or two instruments, stick to it, observe it. You start to see these patterns play out, and then you can take advantage of them and make profit. Okay? So who has a question? Do we have questions? Who has a question about this? Maybe you've encountered this before and you've encountered some problems. How can we help you with that? How can we help you with that? Do we have any questions?
Yeah, I do have a question regarding the candlesticks. Can we have like 2 or 3 formations
Yes.
that can give us a clear indication that we can buy or sell at the
Yes.
same time? At the same time.
Yes, you can.
Okay.
You can. That's what we call confirmations. You can have
Yes.
more than one that's giving you a sign to buy or sell at the same time. Yes.
Okay.
Right.
Thank you very much. This has been very helpful.
Thank you. Okay. Who else is there? Who else has any questions? Anybody else with any question that you would like to ask? All right. In the absence of any questions, I think we'll end the class here. This class is being recorded, so we're going to have this uploaded on social channels, which is on YouTube, and then we'll share the link for us to take advantage and watch it. Please just follow our channel on YouTube, which is Vantage Africa. Or our channel Vantage Africa. Once we post this, you will see it probably by tomorrow or so, or very shortly. We'll have this class posted. Be able to go watch it again and then be able to use it. But of course, so it's we're going to have that uploaded and you'll be able to go back and then watch it. All right. Thank you guys. I'll see you guys on the next one.